Hello and welcome to Weekend Wisdom. Today we're going to answer the question, should you always own international and or emerging markets in your portfolio? Talking heads on TV say, but of course. I, on the other hand, say, no. Stay tuned. We're going to discuss this and much more. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, you can click Show More. It's actually a little triangle there to get additional information and links to today's video. Also, if you find this video of value and are looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing. So international emerging market, should you always have it in your portfolio? Now, I could plug in gold, small cap, make it, whatever, anything really, but I'm going to focus on international for a reason. But first, let's go back before we go forward. When we all become financial advisors, we go through training, we study for our Series 7 or whatever test you're taking, but we're really taught a few concepts. The mantra, we live by this. We are spoon-fed this. It is buy and hold, asset allocation, modern portfolio theory, and the mantra of Wall Street. Now, when I switch from institutional to the retail side, I change my opinion. Why? Because I listen to individual clients. Buy and hold, sometimes they don't have the time. They don't want to go through an 08 type situation. No, I don't want to. Now, asset allocation and modern portfolio theory are intertwined. Asset allocation, large, mid, small companies, growth, value. Then you're going to mix in some international emerging markets. There's your asset allocation model. Bring in bonds depending on risk, maybe a little bit of cash. Pretty simple. Well, last week there was a show that I was watching and they talked about international holdings, second half playbook, and they got into a conversation about it, and here's a quick clip.
Well, we've increased our allocations to international stocks, so we've raised those allocations on average to about 15% of our portfolios.
International, just like Josh Brown was saying, is that a valuation?
So you're underweight international substantially then, because of the market cap weighted MSCI index, just as an example, international stocks are like 48%.
Okay, so there you have it. First off, this is not a diss to Josh Brown or the networks or the individual. I'm just saying I disagree. Just like I disagree with Josh's stock Mishigosh. I have a link up here if you haven't seen it yet. But the point is, you don't always have to have international or emerging markets in your portfolio.
You don't need to follow anybody. You've got to think for yourselves. You're all individuals.
Here, I'm assuming he's recommending up to 50%, and this individual advisor is saying she's about 30% in a 50-50 portfolio. Think about it. If you have, what? A bag or a basket of apples, and one of them's bad, what do? You throw it away. Quality control, if you're going down an assembly line, you pick one out, and you're going to deliver the best possible product. And that's the point I want to make here. Now, she goes into valuations about why it's a good buy right now, and here's my thought on that. Who cares?
Who cares?
I mean, that is a stupid reason. Sure, they're cheap, but they're cheap for a reason, because they're beaten down, and they continue to get beaten down. And I'll show you why. When you look at the charts, it'll show you why not to own. So first, let's go back 10 years. Here's the Dow Global Index, up 50% over the last 10 years, S&P 115. So, what do you see there? That's not bad. It's okay to have it in there. It will dilute your overall performance, but that's okay. We're able to reduce risk. How about emerging markets? Everybody's darling, everybody's sweetheart. The problem with emerging markets is it's good or it's bad. There seems to be no in between. And you can see it. Up, then boom, straight down. Up a little bit, down. Up, way down. Back up, okay, up until year end, and then we're down again. It's tough. So to me, It's like gold. I'm either in or out of emerging markets. Right now we're out, and we're going to show why, but look at the last 10 years. Minus 3.52% versus the S&P. Now from there, if you look at the overall markets and I think valuations, China's valuations are cheap right now. But again, if you look at this article here, I have a link below. Beware China equity bulls. It gets into the valuation story, why it doesn't matter, why you have to be careful. So next up, I took a step further and I ran into some models. I did a 60-40 S&P with a bond index, 2% cash. Then I did a diversified portfolio, showed 4% income coming out, and then my fee as well of 1%. Now you can look at the performance below, but I'm not worried about that. I'm worried about some other things. First off, you see the diversification split. We've got emerging markets and international. Over these 5 years, and I thought that was a good period because we had an up year, flat for a couple years, and obviously a big bump last year. And you see the portfolio really hasn't done much. But there's a difference of about $6,000 in the portfolio that has emerging markets, so it did do a little bit better. Now from there, I took the same time frame, took out international emerging markets, added tech. Well, boy, Michael, that's really easy. But the truth is, right, with the FANGs, we've been overweight tech for quite some time. So I'm going to use that, and I could do just S&P, and I think we're other numbers, and we're going to be okay. But you look here, by taking out emerging markets, look at the difference. $100,000 difference, taking out the withdrawal, my fee, the portfolio value goes from 5 to 616. Big difference. Okay, this is great information, Michael, but how do I know when to get out of the market? Nobody can time the market. I agree with that. Okay, unless you're a Svengali or have some knowledge, but you know, we use the charts to help guide us. Can't be perfect, but we do use them. So here's emerging markets year to date on a daily view. You look at the top, we maxed out at the top like US markets. But boy, it really broke down quickly. So for us, at the top, relative strength, when that started breaking down, we had a big negative crossover on momentum at the bottom. That's MACD. We got out at the end of the first quarter. We looked at the charts. Ultimately, we see that gray area, that's a death cross. 50-day over the 200, another reason why you should be out. And then look at China real quick. Now, China is one of the big ones of emerging markets, but China was deteriorating well before we were talking about tariffs. They have issues there. And you see almost the same look. It went down, and then you see a death cross. Okay, so what is the conclusion? First off, have a plan and know it's okay not to be fully diversified all the time. Yes, I understand it's going to reduce, mitigate, spread out risk, but why carry a bad apple in your basket? If it's going to hurt your overall performance, then why be there? I don't think you have to listen to the mantra, buy and hold, asset allocation, big TV, do what you feel's right, do the research, or work with somebody who's doing the research. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.